Welcome to Building My Legacy podcast. This podcast is designed for leaders and entrepreneurs who want to leave a legacy and will provide strategies that focus upon key elements for legacy creation, determining your desired impact and its benefit, increasing your legacy's reach by engaging key stakeholders, planning, prioritizing, and executing. Here's your host, Dr. Lois Saenz.
Welcome, everybody, to today's Building My Legacy podcast. I have with me today Martin Saenz. Did I pronounce that correctly?
Close. Saenz.
Saenz. Okay. Martin Saenz. He is managing partner of Bequest Funds, and I'm going to have him explain what that is in a little bit. He brings to us really good investing sense. He is renowned as a thought leader in the mortgage note investment industry. And Martin, you're going to have to explain what that is to the audience, because some may know, but some may not know. He is loyal and passionate about creating a better world through profitable business. And he works hard to share and spread success. So many of the people who are in our audience, Martin, will be very interested in knowing, what is the note investing that you talk about? How can they use it? And where does it fit in their planning process? It's all yours.
Sure. Well, thank you. Thank you very much, Lois, for having me on. I'm much appreciated. So I think everything for me stems from the need to build multiple streams of income in my life. That is, something I learned, in 17 years of entrepreneurship. And, I've done the small business road. I have my wife and I manage a portfolio of commercial and residential properties. So we're very active as real estate investors. But we came to a point where we said we really need to build additional streams of income whereby we have reliable cash flow coming into our bank account every month. And so that's really the heart of note investing. So in 2013, my wife and I took a class on mortgage note investing, which basically is purchasing mortgage notes in the secondary market, whereby the borrower has not made a payment in 4 or 5 years, and making a connection to that borrower and helping them stay in their home by creating a loan modification or some other type of creative solution, whereby we're creating a cash flowing asset for myself while keeping the homeowner in their home for a long period of time. So that's the heart of mortgage note investing. And, I've been doing this over the course of years now. And, we manage a healthy portfolio of these non-performing notes, as well as performing season mortgages.
So tell me a little bit. You help a company that has a poorly functioning note. You know what? I'm going to just pause this because something happened to my camera, and we're cut and paste.
No worries.
But I mean, just unplug me for just better.
Yep. Perfect.
Okay. So Martin, if you would go back and talk a little bit about how you got started with the note investing. You were saying that you and your wife looked for an additional stream of income and saw this as a possibility. If you would explain how that works, please, and what got you into that.
Sure. So I'll start it with a little backstory, and I think that will help, put it from a different perspective. So in 2004, I was fired from a corporate job, and my wife and I decided at that point that we needed to go into business for ourselves. And we formed a government contracting company that sold to the federal government. And we endured years of financial abuse to ourselves to get that off the ground. And we later sold that in 2013. And what I found, or what I discovered within myself and my wife and our family, is that business ownership is can be very lucrative. It can be very freeing, but it can also be real restrictive, and it can hold you in bondage in other ways. And so, starting off with 100-hour work weeks, and you can go on from that point. And so, and then what we found with landlording, which is essentially purchasing real estate and leasing it, renting it out on a monthly basis, is that it is a great annuity play. However, it didn't meet our financial aspirations. So we still are landlords over our portfolio. However, what we determined is we needed to become professional investors and find assets that can deliver ongoing cash flow to our family, whereby I don't have to put in 100-hour work weeks. And so this is how we discovered, we ran into note investing as an option. And what that essentially is we purchase notes from banks and various hedge funds, and whereby these mortgages are in default. The borrower has not made a payment in 4 or 5 years. And we purchase these notes, and we assume all the rights and responsibilities of the original lender. So we own mortgages from PNC, Wells Fargo, Deutsche Bank, all these institutions. And so we purchase these loans, and we work with the borrowers in a very compassionate way to get them back on their feet with payment plans they can afford, while we make profit for ourselves. And that's really the gist of it. And we do that through creating loan modifications and other creative solutions for the borrower that deliver 20, 30-year cash flow streams to myself and my company.
So how many properties do you need before you can generate a return? You can have a monthly income based on these notes.
So it's actually not a purchase of property. It's a purchase of the mortgage with that's collateralized with the property. But in terms of the quantity, it's really about what your aspirations are financially, what your necessities are, and what types of mortgages you're purchasing. We own mortgages where there's only a few $1,000s owed on the unpaid principal balance, all the way up to $500,000 owed. And so it's really just a matter of the type of mortgage, the amount that's due, and the workout plan that you negotiate with the borrower.
So, Martin, tell me, you go to the banks or to the funders and create these relationships. Do you know about the properties ahead of time, the borrowers ahead of time, or is it they who bring these to you?
So we operate in what's called the secondary mortgage market space. And so essentially, after these loans are in default and bundled into tranches and sold off into the secondary market, which is essentially a flea market, whereby there's buyers and sellers of these mortgage loans and various other assets as well. Mortgage loans are just one of many assets sold in the secondary space. And so we will go and we will perform due diligence on these notes prior to purchase, whereby we're going to value the underlying collateral, which is the property. We're going to understand fair market value. We're going to understand title, as well as we're going to place underwriting due diligence on the bar, and we'll do credit reporting, skip tracing, and we'll use various other analysis to determine the bar and their ability to pay prior to purchase.
So what's the risk of getting involved in something like that?
So it's really a niche industry. I would just say the risk is not learning the fundamentals prior to entering into the space, and I think that's a risk in any line of business, whether when we were selling to the federal government, or when we're picking up properties to as buy and holds, or we're doing mortgage note investing. So that's key. Full immersion, commitment, putting the time in, and putting your money where your mouth is. I think if you're not doing that out of the gate, that you're going to have a risk of buying a note that you did not perform adequate due diligence on, and you're going to be burnt out of the gate. So it's the whole garbage in, garbage out that you hear about. And yeah.
So do you look for people to join you in making these purchases, or what is it that you're looking for accelerated growth for yourself?
So this is it's a private company that's self-funded for the most part. And so a year ago, my partner and I, what we determined is that we were looking for more of a legacy play. So this note investing industry has done very well for myself. I've written 4 books on the subject, and I speak around the country at various industry conferences, and I've mentored a number of people in this space that have replaced their jobs with mortgage note investing. So on top of receiving that benefit. We decided, my partner and I decided, that we needed to create an income fund whereby we house seasoned performing mortgages, so that we can, get it registered with the SEC, and which is a 506C Reg D fund, and we can take on additional investors and pay them on a monthly basis at an annual return of 8%. So that's what we launched last March. It's a $50 million fund, and we're doing a capital raise for that right now.
So in your capital raise, Martin, how much are you looking for investors to invest with you in order to participate in this?
Sure. So the investment's capped out at $1 million per entity. And so if someone's accredited, that's the one caveat, they have to be accredited. So, what that means is, as a single individual, they have to earn $200,000 a year, or jointly they have to earn $300,000 a year, or have a net worth of $1 million, excluding any equity in their primary residence. So if they meet that criteria and they want to be a part of our income fund, you can come in with as little as $50,000 all the way up to $1 million. And the real benefit is that it's a low risk, high yield fund whereby someone can park money that will earn 8%. But more importantly, they'll get paid on a monthly basis. And that's something that was real important to us when we launched the fund Bequest, because we wanted something whereby we're receiving money on a monthly basis. So it is a good faith effort on our part to pay our investors on a monthly basis, because we see a lot of other investments that will hold money and pay out quarterly or will pay out annually. And we just think if the money's coming in monthly, then we got to pay our investor partners on a monthly basis. And it's an evergreen fund, so there's no expiration date.
So how long do you have to wait after you've made the initial investment before the monthly return kicks in?
So there is a 90-day deployment period whereby we receive the money and we need time to go to the secondary market and deploy the capital. So we do what's called a match investing program. So we wait till we raise capital, then we go out and make a purchase, and then we kind of go from there. There's no leverage in the fund, so the investors are first in line in that regard. Now, with that said, when we have an active trade on the table, we will waive the deployment period for investors coming in. So we only use that deployment period if we need to.
So how often does it happen that, 8% is an average, I'm guessing. So there'll be times like now, many people are anticipating a downturn. Whether or not that's true, I don't know. But should that happen, what's the impact? This is real estate. We know what happened in 2008.
Absolutely. So these mortgages are purchased at a discount. So the coupon rates, which is essentially the interest rate assigned to that mortgage loan, they're typically around 6-7%. So the question is, how are we paying out 8% if the coupon rate on that mortgage note is 6-7%? Well, we're purchasing these loans at a 12 to 14% yield. So we're buying them at a discount, and how we're able to access these notes at a discount is because at some period in time, these mortgages were in default. There's, for probably 3 reasons, which is most defaulted cases occur for 3 reasons. That is love, they get a divorce, underemployment, lose their job, or unemployment, or health. Something happens with their health. And this, I think a lot of people that are listening here can relate. At some point, you had some adversity and you had trouble making your bills. I know I did when my wife and I were starting out in business, but then you catch up, right? You rebound, you get remarried, you get your health back, you get your job back, and then you move on and you start making your payments on time, and you're seasoned at that point after a certain period of consecutive on-time payments. And so these are the mortgages we purchase from banks and other hedge funds, and we purchase these loans at a 12 to 14% yield and pay our investors at an 8% yield. So we're not directly tied into what the Fed's doing currently and how there's a lot of 3% mortgages that are out there currently. It's not tied to that. It's more tied to the activity in the secondary market space.
So how is the secondary market impacted by an economic downturn?
They're most affected with fair market values of the property. So right now, there is a limited supply of housing in the marketplace. And so, equity spikes are occurring across the country. And with that comes more equity coverage over our lien position. So if we have a $60,000 loan and the property's worth $100,000, was worth $100,000 a few years ago, it might be worth $130,000 today. So our equity position, our equity coverage has increased as a result of the fair market value spike. Now, with that said, when we have our next dip, our next correction, which will inevitably occur, that property value may dip down to 90,000 or what have you. But at that point, given a 65% investment to value ratio that we operate the fund with, that fair market value will have to drop significantly before it puts our mortgage position at risk.
So when you're at risk, and if you should start to see those lines meeting or crossing, what do you do?
So our roots are actually in distressed debt. So our team of asset managers, they talk to the borrowers on a daily basis. They're working out payment plans on the side of our company that deals with distressed debt. So we're actually geared to operate whereby we're connecting with the borrower, we're finding out what they can afford, we're creating payment plans to keep them in their homes. So that runs to the root of our operation. And so if we do have someone in our income fund that becomes past due, then we just place them into our system, our system that's operational on a daily basis to get the situation corrected.
Got it. So if it's health or loss of job, it may not be quite so easy to correct the situation, though. So what are your real alternatives at that point? Is it then to look at helping them sell the business and to relocate, or what do you do?
Yeah, so I mean, there's cases where people say, well, I just owe too much on this house and I need to relocate, or something's come up, and they'll sign the property over to us with a deed in lieu. There are other cases where in a very rare case, we actually take the property through foreclosure and we sell the property off at the auction. That's another possibility. We don't want to go down that road. Our whole mission for our organization is to keep them in their home. And so, but, at times that is the inevitable. And, there's other short sales. I mean, we'll help a bar short sale. We've helped the bar perform loan modifications with other lenders on the same property, because we understand the process so well. So we'll look at all the angles. We'll first want to understand what the borrower wants to do. Sometimes they want to leave the house. Then we'll help with options that way. And then if they want to stay in the house, we'll look for every possible option to help them do that.
Got it. So there's a lot of opportunity, and the number of investors you can take on depends upon the investment that they actually make into the fund at this point. Is that correct?
Yes. I mean, we're looking to we're raising 10 million this year. So that's our capital raise goal. So, we're anticipating we're anticipating about 200 in new investors coming in this year. So, we're just looking and we're welcoming dialogue with anyone to just understand if it's a fit. And that's really where it's at. This is not going to be a fit for everyone, but if we're able to have dialogue, then we're able to make that determination up front.
Great. Well, an 8% return is in some ways perhaps a little bit less risky than some of your other choices, right, for investment. And go ahead.
But it's much more than the 8%. It's about creating additional streams of income in one's life. That's the heart of this. So when my partner and I launched the fund last March, we did it right before the country shut down with COVID, and we put $1 million in of our own money. So the first thing is, okay, we're going to go talk to someone else about investing in BQuest. We need to put our own money in. We need to have skin in the game. And it goes hand in hand with our whole mentality, and that is doing whatever we can to build additional streams of income. So right now in my business, I have dozens of streams of income that come in monthly. I mean, I have, 5 books there. I get royalties. I have a training program. I have monthly income that way. We have, hundreds of mortgage notes that are paying us monthly. And we have an income fund. I have my own money in there. I mean, so the money's coming in from every direction. And it's not a boastful thing that I'm hitting on. It is a necessity. So I wake up with a necessity in my heart where I have to feed my family. I have to provide for them. I have 4 children, 8 and under. So I have to create a better future for them. I have to be a model for them. So when they grow up, they're not going to look to be on the dole. They're not going to look to, they're not going to look, they're going to look to excel and to help this world in some positive way. And so if my job's done well and they see what I'm doing, then they'll be the best that they can be and contribute back to this world, which it's all about service to others. But you got to service yourself and be a model for others before you're able to truly help, a lot of people out there. And that's all it's about for me.
It is so true. You do have to service yourself if you're going to service others. And I think, Martin, one of the things that entrepreneurs' education generally doesn't include is a focus on how do you become financially strong. Entrepreneurs get so used to surviving that going to that next level of how do I really thrive and have a life that where I can give back. That's a discussion often people don't get to. So I think it's great to have you bring this to light because it's a possibility of what people can do, right?
Yeah, absolutely. And, first question I have for anyone that I talk to from a coaching perspective is, do you have a living financial statement? So that's the first thing. We can't even have a discussion unless you have a sense of where you're at financially. And so how can you dictate where you want to be financially if you don't even know where you're starting from? And that's really it. And it has to be living. So I wake up every day. I have morning rituals, and one of them is I look over my financial statement, look at all my expenses, I look at all my bank accounts, I look at everything, and I get an understanding of my financial picture. And that's part of about 12 things that I do on a daily basis when I wake up. And it's just, so it's got to be an ongoing thing. But if you don't have any money in the bank, and I was that person for many years starting in business, flat, like in the negative. I mean, broke would have been a compliment. But you have to even be looking at your finances more, because then that's when it'll start to change, when you're focusing on something.
So in our show notes, we will include information about some of the courses that Martin has available, also his books, and information for how you can get a hold of him, because we need strong businesses. We need people who are running our businesses who are financially strong. So this information is important for business owners, for entrepreneurs, and for those of you who are looking for that next chapter of life. Perhaps you're going to start a not-for-profit or something like that to give back. This will give you that backbone, financial backbone, or at least be a part of it, so that you can really do that giving back that you want to give back. Martin, anything that we've missed that we should have talked about but haven't? I have a question before you go there. Mm-hmm. You gave us one of your rituals. What are your other rituals every morning?
Yeah. So I read certain amount of pages out of the Bible. I work out about 3 days out of the week. I do a social media activity every morning. So some type of post or it's my way of saying, hello world, I'm here. I'm still relevant. Yeah. And so, and then I observe if I spent quality time with each of my 4 children the night before. So I kind of try to reflect on that, as well as, some quality event with my wife as well. And so that's what I do every morning and have for years.
Thank you for sharing that. Now, anything we've missed that we should not have missed that you think is important for the audience to know?
I do. There's one thing that I live by, that I believe in my heart of hearts, and that is, I always invest in assets that cash flow and that you have control over, as a rule of thumb. And I learned that, 10 years ago, and it just changed my life. And so if you're investing in the stock market, most of it doesn't cash flow. You don't have control over the outcome. You have your own company, you may have the control, but is it cash flowing? It needs to have those 2 components. You need to have control over your productivity, and it needs to cash flow to meet your aspirations.
Thank you so much. Having the cash flow to meet your aspirations. That's true in running a business. It's true in running our own lives, isn't it?
Yes, absolutely.
Martin, thank you so much for being with us today. And for those of you who are listening to Building My Legacy podcast, thank you for being with us. And remember to visit our website, buildtomorrow.com, and all of our social media sites as well. We will have information about Martin and his books. We'll have links for you so that you can get that information should you choose to do so. Thanks very much, everybody.
Thank you.
You've been listening to Building My Legacy podcast with Dr. Lois Saenz. To book your appointment with Dr. Saenz, visit www.buildtomorrow.com.